Okay, so now we want to talk about pricing financial assets. First of all, what is a financial asset? What are we buying when we buy a financial asset? We're buying cash flows, buying expected future cash flows. So if I buy a share of stock, I'm buying a cash flow. If I buy a bond, I'm buying a cash flow. If I buy a mortgage, I buy a cash flow. If I'm a banker, I'm lending money to you to buy a house for 30 years, I'm buying cash flows. I'll give you X number of dollars today in exchange for this money in the future. So I'm buying cash flows. So we want to price financial assets. Why do companies sell stock? They sell stock to raise money, to buy assets, to generate cash flows, to maximize shareholder wealth. The goal of management is to maximize shareholder wealth. Companies buy assets to generate cash flows to maximize shareholder wealth. So we want to price financial assets. Companies sell stock, companies sell bonds to buy assets to generate cash flows to maximize shareholder wealth. So how do we price any financial asset? Well, what we're willing to pay for it is what it's worth. So the price of a financial asset, I'm going to argue, is equal to the value of the financial asset. That's what you're willing to pay for the value. You're willing to pay the value of the financial asset. It's the present value of expected future cash flows. You calculate the present value of cash flows. So we look at expected future cash flows and discount those back. So as a refresher from 381, the time value of money equation, future value is equal to present value times 1 plus r to the t. So future value is present value times 1 plus the return, or growth, to the tth power, which is going to be number of periods. Well, rearranging from college algebra, present value is future value divided by 1 plus r to the t. So in order to solve for the present value, you discount back the cash flows. Take the cash flow, divide by 1 plus r, the return, to the tth power, number of periods. So how do you price any financial asset? Present value of expected future cash flows. How do you price a bond, a value of bond? It's going to be the price of expected future cash flows. What do we call those cash flows when we buy a bond? We call those interest payments and par value, or face value, or principal. So when we buy a bond, we're buying coupon payments, or interest payments. Coupon payments, interest payments are the same. And we're buying par value. So what's the equation for a bond? How do we calculate the price of a bond? Well, we take the interest payment the first year and discount it back 1 year. So we take the interest payment the first year. We can assume annual compounding for us. Bonds usually pay semi-annually. We're not worried about that part of it. We're concerned with pricing a bond, the basic pricing model. So the interest payment the first year, if you did it semi-annually, then it would be periods. But interest the first year divided by 1 plus r to the d to the first. That's the interest payment the first year, discounted back 1 period. The interest payment the second year, all the way to M, which stands for maturity. Bonds have a maturity. Stocks do not have a maturity. Your car loan has a maturity. Your student loan has a maturity. Your mortgage payment, your house loan has a maturity. Stocks don't have maturities. Stocks do not mature. So we discount back for a bond. We discount back the interest payments for the first year, the second year, all the way to period M, plus the par value discounted back to period M. So the price of any financial assets, the present value of expected future cash flows, is going to be the interest payments discounted back and par value discounted back. Why do I call it RD? Okay? Why do we call it RD? Well, that's a return to creditors. Why do we distinguish between the return to shareholders and creditors? Well, let's go back to our risk-return relationship. Risk on a horizontal axis, return on a vertical axis is a positive relationship. We notice that RD has less risk and a lower expected return than RS. So we're going to make sure we call this RD to distinguish between return to shareholders. This is for the same company. So if this is Home Depot, this is going to be the return to Home Depot creditors, return to Home Depot stockholders. I can't go across companies because you may have a company that has a lot of risk in terms of their debt. So this is going to be for the same company. So return to a Home Depot creditor is going to be lower than the expected return to a Home Depot stockholder. So we make sure we call this RD, which refers to our creditors. Okay, so we're going to discount back our interest payments, discount back our par value. How do we calculate the interest payment or coupon payment? It's going to be the coupon rate times the par value, and I'm going to give an example of that a little bit later. So interest payment is going to be the coupon rate times the par value. Multiply coupon rate times par value. Par value is usually set at 1,000. For our class, we'll set it at 1,000 to make it easier to work with. Okay? The next question is, why is RD less than RS? Why do creditors expect a lower return to shareholders? Well, let's go back to our income statement. Income statement, sales minus cost of goods sold minus administrative expense minus depreciation is EBIT minus interest, earnings before taxes minus taxes, net income. Net income belongs to shareholders. Shareholders get their money last. Since they get their money last, they've taken more risk than the government is. They've taken more risk than the creditors are. So if you go straight to the income statement, you realize that shareholders are taking more risk. They're the last to be paid. They expect a higher return. Okay? So again, this is for the same company. So going back to pricing a bond. So the price of a bond is the present value of the interest payments, all interest payments discounted back, and par value discounted back. So it's going to be each interest payment discounted back, and then par value discounted back. Well, the interest payment every year is the same. The interest payment is going to be the coupon rate, which is fixed, times par, which is fixed. Coupon rate, which is fixed, times par, which is fixed. The interest payment is fixed. So the interest payment is going to be the same for M number of periods. And then we're going to discount back the par value. Well, what do we call something that's the same dollar amount every year or every period forever? Well, we call that an annuity. So the first part of the bond calculation is the present value of an annuity, plus the present value of the lump sum. That's the par value here. Okay? From principals, the present value of an annuity is going to be the payment times 1 minus 1 divided by 1 plus r to the t over r. This is the present value of an annuity. This is the present value of a lump sum. So, to sum it up, the price of a bond is present value of expected future cash flows. It's interest payments, which are fixed, all discounted back, and par value, which is fixed, discounted back. Okay? So the only thing that can cause a bond price to change is going to be the return to creditors. Interest payment is fixed because coupon rate and par are fixed. The only thing that can cause bond prices to change, the only thing is going to be changes in interest rate. What causes interest rates to change? Well, you know from economics, it's going to be the supply of money and demand for money. So interest rates do change, and we'll talk more about that again a little bit later. Now let's talk about the price of a stock. How do we price any financial asset? The price of any financial asset is the present value of expected future cash flows. Present value of expected future cash flows. So the price of a share of stock is the value of the stock, the price of expected future cash flows. What do we call the cash flows? Well, if I eventually sell my stock, it's going to be the present value of all dividends I receive until I sell the stock, and the present value of the selling price. I don't have to sell my stock. My stock doesn't have a maturity date. Bonds have a maturity date. So we're going to have to price bonds assuming we sell it or don't sell it, which we'll talk about in a second. So the price of any financial asset, present value of expected future cash flows, we call those cash flows dividends, and selling price if we eventually sell the stock. So what we do is we discount back our dividends. We take the dividend the first year, bring it back at 1 plus RS to the first, from 381, time value of money from the Principles of Finance class, time value of money. The dividend the second year, 1 plus RS to the second. The dividend the third year, 1 plus RS to the third. plus the dividend until I sell the stock. So N represents a selling period, 1 plus RS to the N. So I'm going to discount back all of my dividends and then discount back my selling price. So again, N is going to be when I sell the stock. Unlike a bond, which I have to sell, I don't have to sell the stock. If I never sell my stock, I'm not going to get a selling price. I'll always get dividends. It's going to be the present value of expected future dividends. Okay? It should be expected here. So present value of expected future dividends. If I never sell the stock, so that's going to be the dividend I expect in year 1, divided by 1 plus RS to the first, the dividend in year 2, 1 plus RS to the second, plus the dividend at infinity, 1 plus RS to infinity. In other words, take the dividends forever and discount those back. When I talk about interest payments are expected, when I talk about dividends, those are expected. Selling price is expected. Anytime we go into the future, it's expected. Okay, so this is understood to be expected dividends when I'm going into the future. So we discount back the dividends. How does a company pay dividends? Again, remember from before, net income belongs to shareholders. I have 2 choices. I can pay it out in the form of a dividend or retain earnings. Why do companies retain earnings? They want to grow the company. They want to grow internally as opposed to selling stock to raise money, to buy assets, to generate cash flows, to maximize shareholder wealth. They get it straight from shareholders. They get it from the money they're making for shareholders from the income statement. So net income belongs to shareholders. I pay out a dividend. Whatever's left over is what I retain. So from your accounting class, retained earnings is what's left over of net income after we pay dividends. So a company earns money, a company earns $100, it pays out a $50 dividend, or say a $60 dividend, it retains 40. So retained earnings is what's left over of net income after we pay dividends. So retained earnings is what's left over of net income after we pay dividends. Okay? So we take those dividends and we discount those back. We discount back the selling price if we eventually sell the stock. If we never sell the stock, we just discount back the dividends. Again, the other thing that's very important is to realize that RS is different from RD. Because we have a positive relationship between risk and return, right? The higher the risk, the higher the return. Creditors are paid first from our income statement. Shareholders are paid last. They've taken more risk. They want a higher return. Okay? Basic risk return diagram. You'll hear me say this throughout the semester in the class. Notice that does not start at the origin. Notice that we have a positive risk-free rate. In other words, investors want to be compensated for their sacrifice. If we started this at the origin, we would say that if you take no risk, you get no return. And that's not the case. If you look at a 3-month Treasury security, very little risk, still gives a positive return. Not a whole lot, not much, but it still gives a positive return. So notice when we draw a risk-return relationship, we start above the origin. We're saying that investors want a positive return even if they're not taking risk. Why do they want that return? Because they want to be compensated for their sacrifice. So this is a basic introduction to price and financial assets. The same thing applies to a mortgage.